Good morning, everybody. Good morning, everyone. First of all, thanks so much for coming out to hear today's remarks. My name is Fred Pinto, and I am CEO of CFA Society Toronto. First, I would like to acknowledge that we are on the traditional territory of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, and the Wendat peoples, and is now home to many diverse First Nations, Inuit, and Métis peoples. We also acknowledge that Toronto is covered by Treaty 13 with the Mississaugas of the Credit. On behalf of our board of directors, staff, and many, many volunteers, we are thrilled that you are joining us today for this marquee event with Deputy Governor Toni Gravelle from the Bank of Canada. I would also sincerely like to thank our sponsors for today, Fiera Capital and Horizons ETFs, for their significant contributions to today's event. Now, when we survey our members, and we survey our members a lot at CFA Society Toronto, they continually ask us for high-quality events and content with high-profile speakers. I'm very confident that today's event will fit this bill, and like you, I'm eagerly anticipating the Deputy Governor's remarks. Following the formal remarks, Toni will be joined by Mari Jensen, past chair of CFA Society Toronto, for a moderated Q&A session. Now that's it for me. With that, please join me in giving a very warm welcome to Deputy Governor Toni Gravelle.
Give me a second while I get set up here. I did remarks at a session in Basel, and I had my contacts on. And then when I came to read my remarks, I noticed that the room was dark and I couldn't see it. So now I'm wearing glasses so I don't look like the person on the screen here. So thank you, Fred, for those kind introductions, and good morning. For those of you that are really keen and really want to see the charts that I'm going to present early on, the speech has already been released on our website, and you can go there and get the multiple color versions of it. I last spoke here at the CFA virtually, because it was COVID, almost 3 years ago. At the time, I updated you on the actions the Bank of Canada had taken to help financial markets and the economy get through the COVID-19 crisis. I expect you all remember the overwhelming panic that engulfed financial markets when the pandemic hit. The resulting dash for cash mindset caused widespread market dysfunction across debt markets, including the market for Government Canada bonds. So we stepped in quickly and forcefully with several programs to make sure these markets could work properly. Our actions did the job. Market functioning was restored. But in restoring market functioning, and later on, supporting the economic recovery, we ended up substantially growing our balance sheet. A lot has happened since then. As the pandemic restrictions eased, inflation increased. In response, we rapidly raised our policy rate, our main tool for controlling inflation. Since April 2022, we have been shrinking our balance sheet through quantitative tightening, or QT. Under QT, we let the bonds roll off our balance sheet as they mature without replacing them. So far, our asset holdings have declined by roughly $180 billion, almost 40%, to about $300 billion. After 2 years, we're getting closer to the end of the balance sheet normalization. So today I'm going to talk about how we plan to manage things after QT ends. There will be some modest changes in the details. The main message is that we will be back to normal balance sheet management process. That is, we will be buying assets simply to match the liabilities on our balance sheet, the main liability being cash in circulation. Let's start with a refresher on how we manage our balance sheet in normal times, like we did before the pandemic. The first thing to understand is that the size and composition of our balance sheet reflects the unique role we play as Canada's central bank. Our assets and liabilities are designed to support our core public policy functions. That separates us from commercial banks and other financial institutions. In periods of stress, we can use our balance sheet to support financial system stability and the economy, as we did during the pandemic. But in normal times, our asset purchases and the size of our assets on our balance sheet simply reflect what's happening on the liability side of our balance sheet. That is, our holdings of financial assets grow passively to reflect the growth in our main balance sheet liability, the cash you guys have in your wallets. When households and businesses want more banknotes for their day-to-day activities, we create and circulate more banknotes via the banking system. That increases the size of our banknote liability on our balance sheet. The amount of cash in circulation tends to track the trend rate of nominal economic growth. So we can usually forecast pretty well that growth in cash, even though we cannot control the growth in cash, the cash in your wallets. When the balance sheet is normal, cash in circulation is our biggest liability, as you can see from the chart there. As you can see on the chart on the right-hand side, before the pandemic. Deposits by the Government of Canada are typically our second biggest liability. The other important liability is settlement balances, which I will talk about more in a few minutes. We must hold a like amount of assets on our balance sheet as liabilities so that the balance sheet, well, balances. So the accountants in the room understand that. To offset the ongoing growth in cash in circulation in normal times, we routinely buy assets and hold them to maturity. These are mainly Government of Canada bonds, which are essentially risk-free. But remember, the key difference between buying assets in normal versus exceptional or stress periods of times is that in normal times, the aim is to hold just enough assets to match our liabilities. So what does that mean for balance sheet normalization? So as QT ends, we will start buying Government of Canada bonds and other assets, again, as part of normal balance sheet management. Those purchases will not be quantitative easing or QE, just as our purchases before the pandemic were not QE. That's the broad overview of how our balance sheet normally evolves. Now let's turn to our settlement balances, also known as central bank reserves. Banks and other members of Canada's high-value payment system, known as LINKs, have accounts at the Bank of Canada in which settlement balances reside. They use these accounts to settle payments with each other. As I mentioned, our balance sheet supports our policy function. The interest rate we pay on settlement balances is equal to our target policy rate. Paying our target rate on settlement balances helps ensure that the overnight market rate used by financial institutions is at or close to our target rate. This is because competitive and arbitrage pressures drive the market rate towards our target. Changes in the level of the overnight rate, or policy rate, in turn influence longer-term interest rates. This is how we implement monetary policy. There are different frameworks for the bank that the bank can use to get overnight market rates to trade at or close to our policy rate. Before the pandemic, we used an approach called a corridor system, which minimizes the amount of settled balances in the system. Since the pandemic, we've shifted to operating in a floor system, which uses a larger amount of settlement balances. Let me explain why. In exceptional times, or in stress periods, such as during the pandemic, our balance sheet grows as we use settlement balances to fund our active, policy-driven asset purchases. Think of this as the Bank of Canada buying assets from financial institutions and paying for them with settlement balances. In the early days of the pandemic, we shifted to a floor system because we were buying a lot of financial assets to ensure market functioning. Banks were left with large amounts of settlement balances in their accounts, so that the rate of interest we paid on those balances served as a floor for the overnight interest rate. In April 2022, we started normalizing our balance sheet, QT. We said that we'd be sticking with a floor system on a permanent basis. Once the normalization of our balance sheet is done, and outside a period of crisis, we will ensure we supply just enough settlement balances to fully satisfy the demand for these from the financial system. We switched to a floor system because Canada's financial system is growing and evolving, making a corridor system less tenable as a framework for efficiently implementing monetary policy. Specifically, we felt it would become increasingly difficult in a corridor system to fine-tune the aggregate amount of settlement balances at the end of the day to ensure tight control over the benchmark overnight interest rate observed in markets. Our floor system makes it easier to keep the market rate close to our target rate. Moreover, a floor system provides the necessary flexibility to implement monetary policy effectively in both calm, normal times and during periods of stress. So how has the financial system evolved? Changes across the payment landscape have meant that payment flows are larger and more volatile than in the past. As a result, there is more demand for settlement balances from financial system in support of payment-related activity. There is also greater volatility in settlement balances driven by our other liabilities. All of that makes it harder for us to keep the overnight rate on target in a corridor system, and why we eventually changed to a floor system. It is also likely that there is more precautionary demand across the financial system for risk-free assets, including settlement balances. Precautionary demand is where liquid assets are held as a buffer against the unexpected, like stashing cash under a mattress. New regulatory requirements have increased demand for liquid assets. At the same time, recent financial system stress events have made risk managers at major financial institutions more likely to use settlement balances as part of their pool of liquid assets. Two events come to mind in terms of market functioning breakdown. One is related to the Dash for Cash COVID period, where we saw a large market dysfunction. And the other one is the liability-driven investment issues that we saw in the UK government bond market in 2022. Both events showed that even debt instruments that are typically expected to be easily converted into cash, such as government bonds, may not be as liquid if markets are not functioning well. Settlement balances, on the other hand, are basically wholesale digital cash, so they are perfectly liquid. So demand for them from LINKS participants has likely gone up. Going forward, our aim is to supply enough settlement balances to satisfy the needs of LINKS participants, but we don't want to supply more than is needed to operate in the floor system. This chart shows, conceptually, where settlement balances are now and what we are aiming for, which is our lowest comfortable level of settlement balances. Why? Why are we aiming for such low levels of settlement balances? Because we want to maintain market discipline to encourage participants to manage their liquidity risks appropriately. For the most part, the opportunity costs associated with holding settlement balances instead of similar assets should limit precautionary demand, particularly when other liquid assets earn a better return. Demand may also be limited in financial institutions if financial institutions feel confident in their ability to access central bank liquidity facilities and convert their assets into cash or settlement balances. If that access is certain and easy, financial institutions will have less need for settlement balances ex ante. Nevertheless, the right amount of settlement balances to supply the system is uncertain. The bottom line is we lean toward holding them at a minimum level needed to effectively implement monetary policy in a floor system. Let's turn now to how we will know when our balance sheet has reached a point where QT will end. As our pandemic-related asset purchases continue to roll off our balance sheet and settlement balances continue to fall, we expect settlement balances to land in a range of between $20 to $60 billion. Based on the maturity profile of our assets, we should get to this range sometime in 2025. Right now, we have roughly $100 million in settlement balances. Lately, we've seen a lot of speculation about whether QT may need to end before we get to those levels of settlement balances. All over the media, and half the room are probably aware of that speculation. What's driving that speculation is the upward pressure we saw in overnight repo markets over an extended period starting in late 2023 and continuing into the early part of this year. We don't think the decline in settlement balances linked to our normalization process has been much of a factor behind the tightness in overnight markets. Nor do we see any signs of stress in the financial system that can be tied to those pressures. Our assessment is that the surge in demand for repo funding in Canada came from a growing expectation that interest rates are going to fall. Late in 2023, market participants around the world became increasingly convinced that major central banks would pivot to an aggressive policy rate cut path. Because of this conviction, many participants in Canada and elsewhere took leveraged long positions in government bonds to take advantage of the expected shift in policy. The more the policy rates fall, the more those bonds will be worth. And the promise of big gains led many to borrow in the repo markets to fund those trades. This chart, which I've taken out of a paper that got published this morning at the same time as this speech, shows how starting in December 2023, high demand for repo funding caused a wider than usual spread between our target overnight rate and the benchmark overnight interest rate, which is calculated from transacted overnight repo rates. So if you follow the blue line, you see this constant march of increased repo demand. In addition to the leveraged long position, the basis trade that is common in US Treasury market has recently become common in Canada. This is an arbitrage strategy used to exploit gaps between the prices of government bonds and the futures prices tied to them. It also boosts demand for repo funding, particularly from a growing presence of active hedge funds in the Canadian fixed income market. You can see that in this chart. Oops, I didn't move. There we go. The yellow line at the bottom is hedge funds in repo markets. When the pressure in repo markets became evident earlier this year, we used our routine policy implementation operations to reinforce our policy rate. This is something we've done for decades, and let me explain. When temporary periods of high demand for overnight repo funding puts upward pressure on the overnight interest rate, we supply additional liquidity to offset that pressure. In doing so, we are acting to keep the rate close to our target for the overnight rate. Our main tool for doing this is overnight repo operations. We will continue to use that routine operation as needed to make sure the market rate doesn't drift too far away from our target. If it did, other interest rate could drift away from it too. That could mean that borrowing costs on a range of loans to businesses and households don't necessarily reflect our monetary policy stance. So we want to make sure that overnight rate is close to where the target rate is. The pressures have already waned. They were temporary. That's partly because upward pressure on overnight funding rates tends to attract new cash providers to supply repo funding to the market. Indeed, the recent launch of daily auctions to lend out a portion of excess cash that the government holds with us on deposit has helped push the overnight rate closer to target. The appeal of leveraged long positions that gave rise to upward pressure also appears to have waned. That's because market participants no longer expect the central banks will ease as aggressively the policy rate. Nevertheless, we'll be monitoring short-term funding conditions as we always do. The recent pressures didn't change our view on the level of settlement balances needed in a floor system, but we are aware there is a risk that we could be wrong about the $20 to $60 billion range. There is uncertainty because it is fundamentally difficult to assess the underlying demand for settlement balances. While we have confidence that daily auctions of excess government cash and our overnight repo operations can counteract temporary funding pressures, you may be wondering what would drive us to decide to end QT early before we get to those levels of settlement balances. We would base such decisions on multiple indicators and a thorough assessment of system-wide funding pressures focused on 1, very persistent upward pressure on the overnight repo rate, 2, broad-based funding pressures that go beyond the overnight repo market, 3, linked participant needing advances from our standing liquidity facility, and 4, market intelligence indicating concern about the lack of liquidity that could be due to longer-lasting factors instead of temporary factors. So that analysis that I'm showing you is based both on data, but very deep and thorough market intelligence. I want to emphasize that we would announce any actions involving the normalization of our balance sheet very clearly and ahead of time. Separately, assuming we have not reached our target level of settlement balances, we have also said that balance sheet normalization will likely continue once inflation is on a sustainable path to 2% and we have started cutting our policy rate. This is, of course, applies only while our policy rate remains in what we assess to be restrictive territory. On the other hand, if the economy slowed sharply, we would likely need to be adding monetary policy stimulus. In that situation, we would probably be cutting rates quickly into stimulative territory, and as such, we'd stop QT. The bottom line is that balance sheet normalization process is continuing, and as I laid out last year, and we have liquidity tools to manage any temporary funding pressures that might come along the way. Before I conclude, I want to explain how we will manage the balance sheet once QT has ended, and we are back to routine buying of assets to offset the autonomous growth in liabilities. Going into the pandemic, our balance sheet was almost totally Government of Canada securities, roughly 70% Government of Canada bonds, a little over 20% Government of Canada Treasury bills or T-bills. And another roughly 10% were term repos, and we had less than 1% in Canada mortgage bonds. Currently, our asset portfolio is entirely bonds, a legacy of a pandemic response, and the maturity profile of these bonds skews longer than it did before the pandemic. So after QT ends, we want to restore a more balanced mix of assets with a broader range of maturities, including more short-term assets than we hold now. Bonds will still end up being our biggest asset type that we hold, but we will also hold T-bills and term repos, just like we did pre-pandemic. But we will no longer buy Canada mortgage bonds. While our term repos will still be auction-based operations, we are considering two purchase options for our other assets. Do we buy Government of Canada T-bills and bonds in the secondary market? Or do we purchase these in the primary Government of Canada debt auctions like we did before the pandemic? There are pros and cons to both, and we're considering both options. Regardless of where we land, we will be guided by our core principles that govern how we manage the balance sheet in both normal and exceptional times. We will acquire assets in a way that doesn't harm market functioning, but rather, whenever possible, improve it. We will also ensure we manage the bank's financial risks. Finally, we are committed to transparency. We will announce our intentions ahead of time so that market participants can prepare for our operations. Before we get to our steady-state balance sheet, which is multi-years away, there will be a multi-year transition period as we replenish our stock of money market instruments, T-bills, and term repos. So we expect that our purchases will tilt towards shorter-term assets for some time. When we start acquiring assets again, the sequence will be term repos at first, then after some time, we'll start buying T-bills, and bond purchases coming a little later still. After this multi-year transition period, when we have reached what we think is our steady-state balance sheet composition, our plan is to roughly match floating rate liabilities with floating rate assets, so term repos and T-bills. Cash in circulation, the cash in your wallet, is assumed to be a permanent liability, so we will continue to roughly match our bond holdings to the size of this liability. So long as our bond holdings are equal to or smaller than our banknote liability, the bank will be protected against losses. A key question is whether it makes sense for the composition of our asset holdings in steady state, several years from now, to tilt shorter term relative to our pre-pandemic portfolio. We will consider this question as we near our steady state portfolio of assets. It's time for me to wrap up and recap the key messages. We've come a long way in normalizing the Bank of Canada's balance sheet. We are getting close to the new normal, but we're not there yet. Normalization of our balance sheet will carry on as we work towards the $20 to $60 billion range for settlement balances. We are also confident that QT was not the main driver of the pressures we saw in the overnight repo markets earlier this year. But we recognize there is a risk that QT may need to end earlier than expected. But meanwhile, the bank has standard operating procedures for any funding pressures that come along the way. And we will be watching funding markets closely for any pressures that could be in the form of longer lasting issues, as such, could warrant a pause in our balance sheet normalization. I'm just going to repeat the exact same messages in French. On a fait beaucoup de chemin pour normaliser notre bilan. On se rapproche de la nouvelle normalité, mais on n'y est pas encore. On va poursuivre dans le même sens. Les soldes de règlement vont se rapprocher de la fourchette de 20 à 60 milliards de dollars. On est convaincu que le resserrement quantitatif n'a pas été un facteur important des pressions observées plus tôt dans cette année dans le marché des pensions à un jour. Cela dit, on reconnaît qu'on devrait peut-être mettre fin au resserrement quantitatif plus tôt que prévu. En attendant, la Banque a des procédures standards pour faire face aux pressions de financement temporaires qui pourraient survenir. On va surveiller de près les marchés de financement. Si on observe des pressions qui pourraient être plus durables, on pourrait repenser la normalisation de notre bilan. Once QT is done and we have resumed our routine balance sheet management process, including asset purchases, there will be a small differences compared to what we did before pre-pandemic, but not a lot. And during the transition for the first number of years, we will work to replenish our money market instruments and restore a greater mix of assets and maturities on the balance sheet. Market participants can count on us to clearly communicate any change in QT or in our balance sheet management policy more broadly. And all Canadians can count on us to manage the balance sheet in a way that lets us achieve our policy mandate as intended and promote a stable and efficient financial system. Thank you very much. There we go.
Thank you so much for your comments, Tony. Merci beaucoup. My first question is on the implications of the end of quantitative tightening. And I think, just to give some background to this question, I know you did a speech about a year ago, and it was called Lessons from the Pandemic. And one of the learnings from the pandemic that the Bank of Canada had is that they needed to be very clear when asset purchases were related to market functioning, as they were at the very beginning of COVID, or related to monetary policy, as what happened in the summer of 2020 when quantitative easing started. So to be clear, what implication does the end of quantitative tightening have on monetary policy, if any, or are they separate?
I want to make clear that our main monetary policy tool to adjust the restrictiveness of our stance or to provide a monetary policy accommodation is our policy rate, the overnight rate. We set up quantitative tightening to be very mechanistic, to work in the background, to make sure everybody thinks paint's drying on the walls. And in that sense, it's a complement to monetary policy. We didn't want it to be the front and center thing. The main point is that we set it up so that our policy rate is the main monetary policy tool.
Great, thank you. And you referenced as well the previous estimate that you had for the lowest comfortable level of settlement balances, which I believe came out around that same period, that same speech last year. And so the Bank of Canada's estimate is still 20 to 60 billion. And can you just explain some of your thinking around that?
Well, I mean, the thinking is that, as I mentioned a little bit in the speech, is that we want to provide enough settlement balances so our floor system runs well. We have good control over the policy rate. There's very little volatility in terms of overnight market rates relative to our target policy rate. But we don't want to have so much settlement balances that financial institutions lose liquidity management discipline. So there's a tension there. So in terms of that number itself, we did some estimation. We're one of the few central banks that actually put out a guesstimate of what that number is. And so that number is based on quantitative estimates as well as surveys and discussions with LINKS participants. So the trade-off. So as I mentioned in the speech, We want to have good control over the overnight rate, make sure it stays close to our policy, our target policy rate. So that means you want to have enough settlement balances so that that arbitrage, that competitive process pushes the overnight rate to the policy rate. But the tension we have is that we don't want to have so much settlement balances that banks in particular who have usually a liquidity buffer or a liquidity ratio get a little bit lax in terms of managing that themselves, in terms of making sure that they manage their liquidity in an appropriate fashion. So that's the leaning. So the upward pressure on repo rates that we saw earlier in the year and late into 2023, a lot of market participants thought that was related to settlement balances, but after we dug a little bit deeper and we have actually access to very specialized data, our understanding became clear that it wasn't settlement balances related, it was actually temporary market pressures.
Right, thank you. And I'd agree that that you are one of the few central banks providing such an estimate. And I guess the downside of that is that the market's become quite focused on the level of settlement balances. I know just yesterday, Chair Powell at the FOMC declined to provide an estimate of the steady state level of reserves. And
I can give you a little factoid on that right now. So right now, the U.S. has about 13 to 15% of their reserves is actually represent 13 to 15% of GDP.
Right.
We're already at between 4 and 5% of GDP number, and then the the 20 to 60 billion dollar range is even lower than that. So we think we'll end up at 1 to 2% of GDP in terms of our reserves.
Right, and your range previously, when the estimate hasn't changed, but 20 to 60 billion steady state level of settlement balances, I think the previous estimate to get there was either the end of 2024 or the first half of 2025. Do you have some more precision on where the timing might lie?
So the one thing we know for sure is the assets rolling off our balance sheet. So we know that, but the reason why we have a range in terms of the timing is because we have to make assumptions about Government of Canada deposits, what size they will be, where they will go, as well as currency in circulation. Currency circulation is a little bit easier. It's kind of tends to run around the same speed, around 6%, which is roughly aligned with nominal GDP growth. But because of that, there's a wide range because of the government deposit, which is an offset. So an increase in government deposit runs down settlement balance. A decline in government deposit pushes up settlement balances. So we have a bit of a range in terms of the timing related, and it's mostly because of the government deposits.
Right. Okay.
And to be fair, as I said in the speech, there is some uncertainty about the underlying demand for settlement balances. We don't have we've done an estimate, but there's no clear data on the actual demand for settlement balance for either for payment system reasons or for precautionary reasons. So that's why we always have the caveat. We could be wrong. The recent period underlined that we weren't wrong. It was temporary pressures, and we have a lot of tools to offset temporary upward pressures in overnight funding markets, either for stress reasons or just for normal ebb and flow of funding demand. But we have the tools to offset that and make sure that we get to our target rate.
Notwithstanding that you said that the core stress wasn't related to settlement balances,
It's not the main factor.
Not the main factor, thank you. There is a large maturity of Government of Canada bonds maturing on April 1st, of which the Bank of Canada owns quite a high amount, so 37 million maturing. I think the Bank of Canada owns 23 million of that. So does the timing of this indicate some fear on what will happen with market functioning ahead of that bond maturity?
So the timing of my speech was really about explaining to Canadians what we will do once we get to the end of QT. We wanted to give Canadians a heads up, market participants as well. And it wasn't related to that maturity at all. We wanted, like I said in the speech, one of our principles is transparency. So we wanted to be upfront and explain exactly what we would do once we get to the end of our normalization process. and give everybody a heads up on how and what we're thinking about and how we're thinking about it. And also, happened pretty coincidentally that we had these overnight repo pressures in late last year, early this year, and it also gave me an opportunity to talk about that as well.
Great, thank you, Tony. You mentioned the various operations the Bank of Canada can use when there is market stress, and we saw the Bank of Canada use that in early January, which was the overnight repo operation. And I think around the time, CORA might have been around 505 or 5 basis points above target.
Yeah.
And it went to a high of 7 basis points. What is the Bank of Canada's comfort level for how far CORA deviates from target?
Well, we have a discomfort, put it this way, for when it deviates too far from target. Okay, it's back on. Didn't want me to talk about it. So we basically have a discomfort for when it deviates further and further from target. What I want to explain is that we have the tools to push it back towards target. One of them is our overnight repo operations, and those can be amped up quite substantially. And then given that there's upward pressure on the overnight rate, that provides certain market participants come in and provide liquidity to the system and make some money. So what we saw also is that the excess cash that the government holds with us, we reintroduce those operations, those auctions that we were doing for decades before the pandemic. We reintroduced those. That allows the government to gain a bit of a competitive rate in the overnight market as well. So between those two tools, we think we have the capacity to cap and contain ebbs or in demand or increases in demand and overnight funding, especially in the repo markets. And there are the same tools we would use in a much more scary situation, a stress period as well. But we have the tools, and I think we have the capacity to definitely counteract temporary pressures on overnight rates.
Right, and those receiver general auctions started, I believe, around Feb 22, and since then we've had a relatively stable level of settlement balances, as you mentioned in the speech, roughly around $100 billion. As we move closer to the estimate, do you expect that we could see more market stress?
Again, we have the tools to offset market stress. We have both the receiver generals, which also can be increased. The government has lots of cash on deposit with us. And those overnight repo operations, we can expand quite a bit as well. So we'll counteract those stresses. If it was a system-wide, if there's something more calamitous like a SVB event or a pandemic type event, then we'd have, that's a whole different ball of wax. What we're talking about is just these sort of isolated increases in demand for repo funding, and we have the capacity to push that. Financial stress is a very different ball of wax, and we have a whole bunch of other tools we would deploy for that.
Great, thank you. I want to turn now to the steady state balance sheet once QT ends. You mentioned in your speech it'll be tilting more towards T-bills. I think
I'll just preempt a little bit of that. So I'll give you a big picture. Right now, we only hold bonds, and a lot of them are pandemic legacies. The bonds we hold, because a lot of them have rolled off our balance sheet, are actually starting to be just 5, 10s, and 30 years, or originally 5, 10s, and 30 years. So our balance sheet is actually tilting long. We have no T-bills. We have no term repo. And what we want to do after QT ends is normalize our balance sheet in another sense. Right now, I'm saying normalization in terms of shrinking it down. What we want to do is move our balance sheet towards what it looked like pre-pandemic. And what it looked like pre-pandemic is that we had a chunk, about 30% of our balance sheet was short-term money market instruments, term repos and T-bills, and about 70% was bonds. But a lot of that 70% of bonds was also tilted towards 2-year. So what we want to do is move, when QT ends, we start buying assets again, and the speed of our purchases, the quantity of our purchases will be predicated on that major liability, cash in your pockets. So as that liability grows, we'll buy assets to hold, to replicate what we were doing before the pandemic. The only reason we buy assets when QT ends is to offset growth in our liabilities, which is mostly currency in circulation. So we want our balance sheet to look like it did before, so we're going to start by buying, and since we have no short-term money market instruments, we'll start by buying money market instruments. We'll start with term repo, we'll start with T-bill, and then somewhat later, we don't know the timing, but we'll buy bonds, and then we'll be buying the mix going forward all the way for multiple years. Our rough estimate is around 2029 to 2030 when we get to the mix we want, the steady state balance sheet. And at that point, we want to ensure that the mix looks like we have the same amount of short-term money market instruments as we have liabilities that pay an interest rate, which is Government of Canada deposits and our settlement balances. And then the remainder of the assets sort of match the currency in circulation, which is going to be bonds mostly.
Great, thanks for the clarification. And you mentioned in your speech that Government of Canada bond purchases could be primary market or secondary market. And can you just explain how the Bank of Canada will be determining kind of that mix?
So we're still deliberating. We're much more open to either one. We're very open to either one. What's going to guide us really at the end of the day is those principles I mentioned. Prudence, neutrality, and transparency. So the transparency part is me doing speeches like this, giving Canadians a heads up, and making sure they understand what our plans are, that we are keen to make sure the market functions well and allows market participants to get ready for operations. Neutrality is about this market functioning aspect. When we return and start buying our assets, we're going to buy in such a way that doesn't harm market function and, if possible, improves market functioning. And then the prudence part is about our balance sheet, risk managing our balance sheet.
Great, thank you. So pre-pandemic, I believe the Bank of Canada's participation in auctions was like 13% in the bond auctions, about 20% of bill auctions. And of course, this time will be different in the sense that we have CDOR discontinuation, the discontinuation of BAs, and we'll have 80 to 90 billion of product coming out of the market. So how does that affect the Bank of Canada's participation particularly in bill auctions? Yeah,
so just to be clear, we're still in QT. The BA transition is going to happen sometime in June. So we won't be in the market for quite a while. Well, I said sometime in 2025. So there's that. I think, as I just said, the way we buy things, either primary or secondary, will be such a manner that we don't harm financial market functioning in the markets we're in. That includes the financial market functioning of the T-bill market. So we'll take that into consideration when we need to go back in and start buying T-bills.
Okay, and you mentioned as well that there would be no further purchases of Canada mortgage bonds, and is that just related to the government?
Yeah, there's another big buyer out there.
Right, the government of Canada.
Well, actually, it goes back to to our principles as well. So it's about the neutrality principle. We don't want to go in there in a way that moves around the price and distorts market functioning. So given that there's some capacity in terms of free float of Canada mortgage bonds that's been removed, we thought it's much more prudent and more neutral for us to not be in that market.
Thank you. And now turning to something a little bit outside of the focus of today, if that's all right, but we just got the February inflation on Tuesday, and then yesterday, actually, the minutes from the March 6th meeting contained some color on how the Bank of Canada is looking at inflation. Talked a little bit about shelter costs, and a bit of an anomaly in Canada is that we have mortgage interest costs as part of our shelter costs, so as the bank's hiking rates, it's contributing to inflation there. So what are your thoughts around February inflation and how the inflation picture is evolving?
Sure, so the number came out, very encouraging, but it's one number, first of all. We're going to look at it in the aggregate. We're 2 weeks away from an NPR projection. We're going to look at that data, look under the hood of that data, try to understand what it means in aggregate across previous CPI numbers and other macroeconomic data. So stay tuned on that. I think on your underlying inflation point, I mean, again, we're trying to get a good sense of underlying inflation and where it's going. And that's what I meant by we're going to look under the hood of that data as well as other data. The 4 indicators we've been watching: excess supply, wage growth, firm pricing behavior, and inflation expectations. So all that will come together for our monetary policy projection that comes out in almost 2 weeks, less than 2 weeks.
Unfortunately, we're at the end of our time with you today, Tony, but thank you very much for your transparency. You've done a great job answering all the questions.
Thanks.
And
No, it's
really
a pleasure.
appreciate
I
it.
must say it's a pleasure. I run the financial markets part of the bank, or oversee the financial markets part of the bank, and you guys are my stakeholders, so thank you very much.
Thank you.